Collective research. Active fundamental research in global capital markets. Make informed decisions.
Niu Technologies is an electric scooter company headquartered in Beijing, China. Yan Li has been its CEO and COO since December 2017. Founded in 2014 by two ex-employees of Xiaomi, it is now one of the largest electric vehicle manufacturers in China. Early on, it differentiated itself by using lithium-ion batteries as opposed to the cheaper lead-acid alternatives widely used in Chinese e-scooters at the time. It had nearly $300 million in revenue in 2019. As of November 2020, 98% of its sales were in China. In 2018, it was listed on the NASDAQ stock exchange under the ticker NIU.
NIU deliveries. The data suggests a decrease in sales for both the China market and international markets in the third quarter of 2023 compared to the same period in 2022. Additionally, the year-to-date figures for 2023 are also lower than the corresponding period in 2022, indicating a general decrease in the company's sales performance. Operating margin. In 2018, the operating margin was negative at -3.49%, which means the company was operating at a loss. Over the years, the operating margin improved and reached 5.50% in 2021, indicating that the company was able to turn a profit. However, it decreased to -1.50% in 2022, suggesting a return to a loss. Net income. In 2018, the company had a net loss of -349. The net income improved significantly in the following years, reaching 226 in 2021. However, it declined to -49.5 in 2022, indicating a loss again. Net margin. In 2018, the net margin was -23.6%, indicating a significant loss relative to revenue. The net margin improved over the years, reaching 6.10% in 2021. However, it declined to -1.56% in 2022, suggesting a return to a loss relative to revenue.
Assets. The company's total assets increased steadily from $172 million in 2018 to $368 million in 2022. This suggests growth in the company's overall value and resources over the 5-year period. Liabilities. Liabilities also increased during this period, from $89 million in 2018 to $178 million in 2022. While liabilities have grown, it's important to note that they have not grown as rapidly as assets. Debt-equity ratio. The debt-equity ratio is a measure of the company's financial leverage. A lower ratio generally indicates less financial risk. In 2018, the ratio was 0.32, and it decreased to 0.18 in 2020, signifying a reduction in financial risk. However, the ratio increased again to 0.36 in 2022, indicating higher leverage compared to 2020.
Quick ratio. In 2019, the quick ratio was 1.59, indicating that the company had sufficient liquid assets to cover its short-term liabilities. The quick ratio decreased over the years, reaching 1.16 in 2022. This decline suggests that the company's liquidity position has weakened, potentially making it more challenging to meet short-term obligations. Current ratio. In 2019, the current ratio was 1.89, indicating a strong ability to meet short-term liabilities. The current ratio fluctuated over the years, with the lowest point at 1.68 in 2021 and the highest at 1.89 in 2019.
PE ratio. In 2019, the PE ratio was 23.35, indicating that investors were willing to pay 23.35 times the company's earnings for its stock. In 2020, the PE ratio increased significantly to 82.35, suggesting that investors were willing to pay a much higher premium for the company's earnings. In 2021, the PE ratio further increased to 35.14, but it was lower than in 2020, indicating a potential price correction. In 2022, the PE ratio became negative at -57.23, which is unusual. This could be due to negative earnings, which might be a concern for investors. PS ratio. The PS ratio in 2019 was 2.14, indicating that investors were willing to pay 2.14 times the company's annual sales. In 2020, the PS ratio increased to 5.68, suggesting a higher premium on revenue. In 2021, the PS ratio decreased to 2.14, indicating a potential correction. In 2022, the PS ratio was 0.89, which is lower than in the previous years, suggesting a lower premium on revenue. This data indicates fluctuations in investor sentiment and valuation metrics over the years, with a significant increase in 2020 and a subsequent correction in 2021. The negative PE ratio in 2022 is a noteworthy anomaly, potentially linked to negative earnings.
If you would like us to research a stock, please tweet at Collective REC or leave a comment here.
Like and subscribe for potential investment ideas. Become a member at www.collective-research.com.
Receive investment ideas before they are published.
Collective Research. Active fundamental research in global capital markets. Make informed decisions.